All right, everybody, welcome. Thank you so much for being here for another one of our 101 level webinar sessions. Mission at Gust is to help fewer companies fail for avoidable reasons. We do this in a variety of ways. The first of which is these high level education sessions that we do with everybody from lawyers to accountants to pitch deck helpers to accelerators to help you figure out how to navigate your startup journey. And then the other thing that we do is something that we've recently launched that gives you the opportunity to engage with us at kind of a deeper level. We're calling it Mission Control. Essentially, the pitch is you shoot for the moon and you worry about building your business. We'll help you manage everything below that. So that means you get to come in and ask us questions face to face, dive into detail a little bit more than we can in the Q&A 15 minutes that we have at the end of sessions like this, and gives you access to a little bit of a different community and knowledge base than you get at our one-on-one level. It comes with early stage expert support. We do weekly office hours and workshops. You'll get the opportunity to sharpen your pitch materials, including your financial model. You'll also get 40% off Gust software. And basically, the idea here is that we take all the questions that kind of come up and feel overwhelming in the background of running your startup and turn that into a nice launch pad for you to actually get your startup off the ground. That segues really nicely into our guest today, Matt Grattan from Zamp, who is here to talk to us about all of the weird things that happen under sales tax Nexus in the wake of the Wayfair decision of 2018. This is one of those tricky things where things have recently gotten way more complicated. And it's one of those things that founders kind of look at and their eyes glaze over and they say, okay, I'll figure that out later. It turns out there are really good reasons for you to figure that out as soon as you start selling, or at least have a plan. So with that, I will turn it over to Matt. And Matt, let me get your slides pulled up real quick.
Awesome.
And you're up.
Great. Thanks, Peter. Yeah, so the concept of economic nexus started back in 2018. This is after the Wayfair versus South Dakota decision, which I'll go in more detail on. But this is a question in terms of truly understanding what economic nexus is challenging. There's just a lot of things that go into the determination. It varies by state and so on. So the goal of this session here today is to help you kind of understand what it means, how it impacts your business. If you're a startup, right, and you're an early stage company, it's important to understand the impact because you're going to grow, right? And as you grow, your requirements grow from a compliance perspective. So that's what we'd like to do, is because I can tell you that over the past years, I've had companies that have come to me that didn't really try to understand it and ignored it. And it really impacted things later down the road in terms of, whether they were looking to sell the company, looking for investment, things like that. Like it really has impact. So again, the goal is here to provide that education and so on as part of this session. So a little bit about me. I live on Bainbridge Island, Washington. It's like a 35-minute ferry ride from Seattle. My wife, 3 kids, and our dog, Ruthie. I had to mention Ruthie. So I've been in the sales tech. I currently work at Zamp. I run partnerships and sales. I've been in the sales tech space now for 12 years. I never thought I would have that long of a career in sales tax, which is really interesting. And I have also presented to Congress years ago. I was asked to come in and talk about how technology solves the challenge for small and mid-sized businesses that would have to collect and remit sales tax across multiple states. And really interesting thing about that presentation was part of the hypothesis, or the whole goal of the presentation, again, was that technology is in the answer. But as I've learned over the years and the way things have gone, it's more than technology. There's more than technology involved in this. So as far as the session today, we'll cover a little bit about the growth of e-commerce, why that matters, some history around sales tax. I know that don't get too excited, but I'll cover that as well. We'll also go through the concept of Nexus and what it means. I've got some infographics with some data to share. We'll cover certain scenarios as well, that common scenarios that we're seeing and things that you can avoid, and then we'll do a Q&A session at the end. So e-commerce growth, ultimately it continues to move up, right? It continues to go north every year. And I wanted to share this slide because what's interesting is in 2018, and we'll cover Wayfair versus South Dakota, that's when the Supreme Court decision occurred and the concept of economic nexus started. States started to report and track remote sales. So these are sales that are happening interstate, meaning coming in from other states, so California to Texas, New York shipping to Illinois, and so on. So interstate sales, they started to track those sales. And what was interesting was in 2021, 33 states reported versus 23 states in 2018. They're getting smarter in terms of how they're tracking remote sales. They've got more sources. They're using technology more. I know it's hard to believe that the states are actually using technology, but they are. And they are getting better at tracking all this data. And they're doing so because they want to understand, because of economic nexus, what is the amount of revenue that, tax revenue, sales tax revenue that we may be missing out on. So they want to know, hey, how much volume is coming into our states? We know the states like California, New York, Texas. I mean, there's a huge amount of volume that goes into those states, but these other states, they're now tracking this very closely. And I think it's important for you as a company that sells around the country to understand that. For sales that occur within their state, right, intrastate, they know, hey, all of our retailers are commonly charging sales tax for orders within the state. But again, what's happening with these remote sales? So let's go into a little bit of a history of sales tax and kind of the whole this concept of nexus. So first, I'll cover Wayfair versus South Dakota. So in June of 2018, this went to the Supreme Court. So Wayfair basically said, hey, we can sell in South Dakota. We don't have a physical presence in your state, and we don't need to charge sales tax. And South Dakota said, hey, no, we want you to charge because you're doing a lot of sales volume in our state. Our consumers in our state are buying a lot of your product that you're shipping. So we want you to charge sales tax. Well, it went up to, it was unconstitutional, by the way. Whatever South Dakota was saying at the time was unconstitutional based on the laws at the time. But this case went to the Supreme Court and they ruled in favor of South Dakota. And when that happened, what that allowed states to do now is to bind you to collect based on how much you sell in each state. And in classic fashion, the rule passed in June. By probably early mid 2019, almost every state, I think Florida was one of the last ones, but almost every state had an economic nexus law. And then each, of course, in true state fashion as well, they all rolled out different requirements, different timelines, different things that count towards it, different penalties and deadlines. So there was a lot of variation in terms of, taking this Supreme Court decision and then giving every state essentially the authority to now put in their own rules. And there was just a lot of variation that occurred, versus maybe it being federally mandated by allowing states to do it. Obviously, there was a lot of variation that occurred, and we'll cover that in more detail. Let's go into Nexus. So there's really, when you think about Nexus is from a sales tax perspective, it gives you the state the right, to bind you to collect sales tax in their state. And there's really going to be two triggers they look at. Let's go to the next slide. Physical. So this has always been the case, right? So physical is, oops, there we go. You have an office in our state, you have employees in our state, you have inventory, right? Those are common physical triggers. I like that back. It's going back and forth there.
Yeah, sorry. I'm trying
That's
to.
okay. That's okay. That's good. It's good. It's good. It's keeping me awake. So, but the reality is that it's always physical has always been there. I go back to pre 2018, and we would be talking to companies that were using like Amazon FBA. So when you think about using like their distribution centers throughout the country, you give them product, they move it through, I think it's roughly 26 states or so. That would trigger a physical nexus in any of those states. If you use a 3PL to ship your product, from a logistics perspective, that will trigger it as well. So there's different triggers. Attending trade shows can also trigger it. And it varies by state. Again, every state has their own physical nexus rules, but there are certain commonalities, employees, inventory, locations, things like that. And then with economic nexus, it all became about tied to your sales. And they either look at orders or revenue, and some states look at both, right? And it could be tied to either your, wholesale revenue, your retail revenue, your direct to consumer revenue, and there's also marketplace revenue that can be impacted in terms of the definition of economic nexus. So let's dive into these infographics. I think this kind of tells the story. Across Nexus triggers, there are 21 states that say, hey, if you do 100,000 or 200 orders in our state, and it's going to be, the timeline can be over previous calendar year, current calendar year, trailing 12 months, or previous calendar year. We'll go into that, but each state has different timelines according to Judge That. You've triggered Nexus in our state. Now, what's interesting is, as a smaller company, as a startup, 200 orders, you can get there pretty quickly. And the way I look at that is, if you sell a product that has a really lower, average cost or average sale value, you're going to trigger that 200 order number. If you're selling a product that's $10 or $20, you're going to ask yourself the question, does it make sense to register in that state today? Or should I wait till it becomes a little more material? So those are questions you have to ask yourself. But legally, you've triggered Nexus in that state once you hit 200 orders. So Ohio, if you do 200 orders or 100,000, you trigger Nexus. Literally, that 200 order mark, once you get there, you're supposed to collect and remit, register and collect and remit. There are states that look at just 100,000 in revenue. So Washington, where I live, that's one of the rules they have. Two states look at 500,000. That's Texas and California. One state looks at 500,000 and 100 orders. That's New York. One state also looks at 100,000 and 200 orders. So not or, and that's Connecticut. And then of course there's four states that don't collect sales tax. So there is some commonality in the first two categories, 21, 20 states. But again, it's varying, across enough where it's just a headache to track all of this, to try to comply. So this is the other layer of complexity, which is if you sell in multiple channels. So the obvious thing is your taxable sales, your retail sales count towards the order or revenue definition. But what we find is, this is where a lot of companies miss this. Some states count wholesale orders, some count just marketplace orders, some states count both. So there's upwards of 4 different categories here. 5 states plus DC count marketplace. 7 states just count wholesale. There's 23 states that look at both wholesale and marketplace towards your Nexus definition. Now you could say, hey, why do they count? Like, my wholesale orders, I'm collecting an exemption certificate, or someone's reselling my product, there's no sales tax. Well, again, they're looking at as your gross sales volume to count towards the number. Same thing with marketplace. Like if you sell on Amazon, Amazon under the marketplace facilitator law is required to collect and remit for any sales in their marketplace in any state in the US. But the state still wants you to count that revenue towards your definition of economic nexus. Even though you're not collecting any tax, they want to factor that into the numbers. And then the time period. So 34 states plus DC look at previous or current calendar year. So they go back, they have a look back 12 months for the previous year, and they look at the current calendar year. And a calendar year, once it hits December 31st, you start over, which is kind of nice. There are 9 states that look at previous 12 months, trailing 12 months. There are 3 states that look at just previous calendar year. So that's even a little more fair. They don't look at the current, they just look at the previous. So again, this is another layer of complexity, right, in terms of the determination. First, you got, your revenue volumes, right? And then you've got, your different channels. And now you have a different time period for tracking it. So that's 3 layers of variables that can determine where you should be collecting or remitting sales tax. And this gets even more comical because once you hit Nexus, you triggered it, right? What you should do? What should you do, right? So 16 states plus DC say, hey, the next transaction next day or same day. And for the states to put that on you to say, hey, you've triggered it, you got to start collecting the next day or the same day, or it's almost absurd. I just feel like it's like we are going to move as not necessarily as very fast. I don't know if you ever worked with the states before, but you call them, you're probably going to be on hold for an hour or so, but things just don't necessarily get done quickly there. And I find that, to put that onus on merchants, it's pretty significant. So to say, hey, you gotta do it immediately. And then there's all these other laws. If you go to the next slide, Peter, it's just like, again, it almost requires, like, in some interpretation here, you almost need a lawyer to interpret some of this language here. I will say this: Texas, to me, has the most, well, Texas has a deadline by the first day of the 4th month after threshold is exceeded. So I don't know, try to figure that out. That's always an interesting one. But what we look at with this is we tell customers this. I mean, ultimately, at the end of the day, once you trigger it, I think a reasonable path is to say, hey, just register the 1st of the next month. So take all of this chaos that the states have created and all this variance and just boil it down to something that is reasonable. And reasonable says, hey, I trigger it in April, I'm going to register as of May 1st. I think registering, by the way, at the 1st of the month always makes sense. I don't think registering in the middle of the month makes sense. I want to start fresh at the 1st of a month, right? Whether you do it the previous month or the first, the go forward month, but I think that's a reasonable thing to do, instead of, again, trying to interpret all of these laws. So I wrote a blog about this, and I want to, I guess before I jump into this, I want to share something that I think is really important. I've had conversations with different people in the sales tax space, all the way from state level, people that work in the Department of Revenue at certain states, and the common, well, not that I've heard feedback that we've messed up. We have messed up. I mean, we have completely screwed up. We've made it too complex. There's too many variables. And by the way, that's just Nexus. So once you register, think about the concept of calculating accurately across 12,000 jurisdictions. thousands of products and services that have different rules, both exemptions, partial exemptions, depending on when you sell them, at the price you sell them at. Think about filing. And every state has a different format and requirement in terms of how you have to report. Think about also the concept of like the schedule of filing, different due dates, quarterly, monthly, 20th of the month, 28th of the month, and that it carries interest and penalties if you don't do it right. So I think about this in terms of how really unfair it is to the small business. And, back to when I presented to Congress, I was getting hit with questions from some politicians, lobbyists, some interns, questioning, hey, how is the small business going to manage this? Right. And they were right. I mean, because ultimately, because it didn't go to a one common rule nationwide, it went to, hey, we're going to let every state make their own decisions. All they did was take the complexity they already had and then layered it even further up with, triggers to tie you to, to require you to collect a remit in the state. And I think about that in terms of just how unfair it is to the small business. Now, that said, we talked to a lot of companies that want to comply and they've made mistakes. We've also talked to some companies that were just like, hey, we just forgot about it or we just didn't do it. And we recognize, we're not compliant. We got to fix this, right? So I'll just go through some common scenarios and, I think it's just good to kind of understand what we're seeing out there. So first, we made this fictitious person, Clifford, the tax auditor. Not really somebody that I would want to go out for drinks on a Friday night with, but
Yeah, just a really sympathetic character.
yeah, not sympathy, no sympathy at all, right? He doesn't even have eyes. I mean, for God's sakes. But Clifford is somebody that the state hires. He's very good at what he does, and he knows how to get companies that are non-compliant. He knows what to look for. And with all these layers of complexity we talked about, Clifford is pretty successful when he goes out and audits companies for sales tax. He usually comes back with a check or, some type of a win. So let's go through this and he'll share feedback as well. So here's a common one. Just made an example. It's a Shopify customer. Shopify is an e-commerce platform, which probably most of you know that. And they have a dashboard that shows you where you've triggered a requirement for various states. So they have a tracking mechanism there. And, you trigger it and you turn sales tax on in Georgia, but you never register. So you collect in Georgia for 6 months, a year, maybe it's a couple of years, and you still haven't, remitted anything. Once you collect money from a customer sales tax, it's your fiduciary duty and legal responsibility to remit that to the state. Now, if you are incorrect in collecting it, and we do come across companies, even startups that will say like, hey, I just turned sales tax on everywhere. I thought I was supposed to collect everywhere, but they're not registered in any state. They've never remitted anything. You do have the option of going back and refunding your customers. The challenge with that, though, is you've done probably thousands of orders, and to go back and refund every customer would just be a customer service nightmare. So that's a common issue that we're seeing is we turned on these states to collect. We haven't registered. We're not in the process of registration. It's a big issue, and it's something that you really want to avoid. Now, it can be cleaned up, of course, like we can, register you with an effective date of a previous year or whenever you started collecting, and we'll start, filing those overdue or past due filings. There will be interest and penalties you'll pay on that, but it'll get you current and then, go forward compliant. But this is just a common thing. If you turn sales tax on, make sure that you're looking to register in that state. You're in the process of registering, or you have registered in that state. So another one is, a product that you sell or a service you sell is exempt in a state, but you're selling ebooks, for example, in California, you trigger economic nexus. Digital content and ebooks, SaaS, et cetera, it's exempt in California, but you're now charging customer sales tax for this. And this is a common thing we've seen across supplement companies, which is a common exemption, various clothing and apparel. There's certain states that are exempt there for that. Medical healthcare items. So there's different categories that are common areas of exemptions. Food and beverage is another key one. So you always want to make sure whether you're selling on Shopify or whatever platform you're selling on, that they have tax codes that you can map to make sure that you're applying the appropriate exemption or partial exemption in any state. Because the last thing you want to do is charge your customer sales tax when the product should have been exempt. It's a customer service issue. It can impact your sales as well. The second thing is, if you sell a product that's fully exempt, so you have one product you sell, like digital books, and you're selling to California, it's exempt in California, you say you've just triggered economic nexus there. There are some people that would say, hey, you should, register in California and file $0 returns. You're not collecting any sales tax, but you should, you should do that. You should register and do $0 returns. Other companies say, I'm not going to register. Like, that's like pushing paper. Why do I want to register where my product is exempt? I'm not going to register in California. I believe, and I use the metric of, or the analogy of, where did you sit in high school in the classroom? Did you sit in the front, the middle, or the back, right? So usually that kind of helps you make the decision of, how much you should comply. I'm not a big fan of having companies that sell one product type that's exempt in a state, and they've triggered Nexus, economic Nexus, registering it and remitting in that state, because it's all $0 returns. So again, that's my feedback, but other people will, potentially want to go ahead and register. Just, again, they probably sat at the front of the class in high school. So, all right. So this is another scenario. You're tracking your Nexus, and this goes back to what we covered earlier, right? So you're like, okay, I've got a resource to track it. I'm on it. I'm looking at my retail data, so my taxable sales, but I'm also now selling on wholesale and marketplace. So I've got a lot of wholesalers, and business is great in that channel. I sell on Amazon. I've got TikTok orders, right? Everything is going well, but I'm only counting my retail, my taxable direct-to-consumer orders against economic nexus. Well, Texas counts everything. It's one of those states that looks at wholesale, marketplace, retail. So you have a big wholesale account, you sell wholesale accounts, you got a lot of sales on Amazon. You could have triggered economic nexus in Texas. Actually, I don't think nice rhyme there, but you could have triggered that months ago, years ago, and you didn't know it because you weren't counting a lot of those channels. And Texas is a lot of volume, right? So again, that's a potential liability that you have. So one thing I always say to customers is, go ahead and make sure you do an assessment, right? Get an assessment, a clean bill of health, where you're at. Make sure you're including all of your channel data as part of that process. Because again, it's important that you're following each state's rules, for Nexus. Another common one, again, sales tax is an afterthought, right? You have certain states you have to file monthly, others quarterly, and you may have a few annual returns, and you have to stick to the deadlines the states have. You have to file in the right format, and people get behind, and they're just like, hey, I'm not up to date on my state filings. And it's just, I'm overdue. We see a lot of companies that have, past due filings for 6 months, a year, and so on. And they just said, forget it. I don't have the bandwidth. I'm not going to do it. Or the partner or a process they had just kind of broke down. It just wasn't functioning. And, they're now in a process where, they gotta catch up. And so what happens when you're doing that is you can expect to have interest and penalties on doing those past due filings. It's so important, though, to get them addressed. So partnering with somebody to either, take care of them or, taking care of them on your own, but really important that you get those addressed. Now, some of that sales tax that you collected, if you've if you don't have it, sitting in an account, so you haven't put it as a liability in an account that you're ready to pay the state for, and you may have spent it. I mean, I've spoken to some, customers that have said, hey, we collected, but we just kind of threw it into one bucket and the money's been spent. If that's the case, there's a couple of things you can do there. One, you want to get current on your current filings, and then you can do things like payment plans with the state, or when you get cash flow coming in, you can just start paying it off. It starts, for the furthest back, and then it works forward. But it is a process you want to get going on, because again, the interest and penalties continue to accrue. And Clifford, he's one of those people that just loves those interest and penalties. He makes his day. So then the last piece, and I mentioned materiality earlier, but your company triggers Nexus in Arkansas. Maybe it's tied to the order amount, and you owe less. You sell a low cost product than it would cost you to register and remit using a service or whatever have you. You might just say, hey, you know what? It's just not worth. It's not material. I owe the state $100 or whatever it is. I'm just going to keep an eye on it, look at my sales in that state, but it doesn't make sense for me to go and spend the time and money to register in that state. And it's the concept of materiality. Really what that means is Clifford and Pete, if you can just push the button, I think Clifford will pop up here. There he is. Yeah. So, hey, he's got bigger fish to fry. He's not going to come after you for the $100. He really doesn't care about it. So it's something that's really of low importance to him. And so ultimately, I think, again, you can just make these decisions. This is just using logic, in your decisions, and what's right for your business. Great. So I think we got to maybe have a Q&A if there's any questions coming through.
Yeah, we do. First, I just want to talk through some of this stuff because it's fascinating, and I love the way that you presented it, and just ties into some things that are necessarily factual about running a business in the early days, and that you can trust to some extent your intuition about these things and logic, and rely on the concept of materiality. But it's really important to understand what's coming up ahead so you can properly balance the risk. Because eventually, if you go to raise funds and you have a large back tax liability that's going to take a lot of time and money to clean up, those can be roadblocks, right? And there are things in the future of your company, like fundraising, that are going to be hard enough already. So you don't always have to dot all of the I's and cross all of the T's at every moment, right? At the exact moment, in the way that some states would like you to, right? The minute after Nexus is triggered, you should be registered and remitting, right? But you should cultivate, and that's what programming like this is designed to do, cultivate an understanding of what's out there, how it applies to your company, so you can properly and continuously weigh, like, okay, is it worth it? Is it material? When is the right time for me and my company to take care of it? So thanks for being here, Matt. Great presentation. Love Clifford. We do have a few cool questions to get through, or nerdy questions, depending on the way you want to look at it. The first is asking about a software product. And I think a lot of our startups will be software related, so maybe we can dive into even more on this. But asking if a user purchases company software from a non-US location, do they pay any US sales tax? And if so, which US state? They are headquartered, and I assume by that statement have physical nexus in Washington State. And clarity around this is software is only distributed via the internet as a digital download.
So they're a non-US company, and it's a US company selling them software.
Well, it looks like US-based company in
Yep.
Washington.
Yep.
And they are selling software into non-US locations. So the buyer is physically located outside of the United States.
Yeah, so then there would be no sales tax involved in that, because when you think about the sales of software and digital goods, SaaS, et cetera, it's always based on where the service is consumed. So the one thing I would say to you, though, if you are selling overseas, those countries have their own rules specific to digital. Like, for example, the EU has rules specific to digital products. And so that would be one thing, depending again on your volumes. You want to make sure you understand the rules of other countries specific to things like value added tax, et cetera. But there would be no US sales tax required on that type of an order.
Awesome. Thank you. And see, next up from James, we've got, does a company have a sales tax liability if they had Nexus triggered in the last 5 years, but they never started collecting from customers? Or would the tax just be due from when you start collecting? Let's start there. There's more to that question, but I think that's a good initial question to start with.
Yeah, so when I think about like if you've triggered Nexus in previous years, one would be to understand what triggered that. Was it a physical trigger, like, or was it an economic trigger? And then ultimately you have to make some decisions. So one will be to say, hey, do I want to go back to that effective date that I triggered it and collect on any sales coming forward to the present? And that would be paid, assuming probably paid out of pocket, because you're not going to go back to your customers and ask for the money. So you would pay that out of pocket to be current, and then you'd start filing, going forward and so on. So I think it's important to kind of understand though, when you triggered it, what was the reason for the trigger? What's your status within the state today? If it was an employee, is that employee still in the state, or do you not have any employees there, and so on? So those are things you're going to want to look at. And again, back to materiality as well, like Peter mentioned, I'm going to look at how material it is. Just so you know, the look back periods states have for audits, typically they're going to go back like 3 years. If you're non-compliant on reporting and such, states can go back as much as 7 years. California's 8 years. Texas can go back infinity. They always go big in Texas, but typically, you're going to be looking at a couple year look back period. I think the biggest thing, again, if you're in that situation, understand what's my liability exposure in that period, and then what makes sense for my business based on where I'm at today. So it's something you want to kind of evaluate specific to your business.
Cool. So I think that actually covered a piece of the follow-on question there around penalties that apply for not registering and having to go back and pay the tax. Technically, yes. Once you establish economic nexus and you do have, even if you don't know it, a sales tax liability, theoretically you are on the hook for that even if you didn't collect it. But as Matt said, going back and understanding how material that was, whether you're in the total of that 5 years, if you're in the situation where that total would be less than the cost to register and remit, then maybe you can make a different decision than if you've been doing gangbusters. Because if you're doing gangbusters in that state, then eventually Clifford is coming to knock, right? The bigger you get, the bigger the fish you are in the state, the bigger revenue opportunity there is.
Yeah, there was just so you know, I remember, and this is just my recollection. We did a survey years ago. I remember reading a survey of once you get to $50 million, and this is again years ago, like probably 10 years ago. So data may have changed a little bit, but once you become like roughly $50 million, you can expect one audit every 6 years is on average. So if you're below 50 million, you're below 20 million, your chance of audit is greatly reduced based on your size of your company.
And last note on that, and I think interesting perspective to inject is, James is looking at this from the perspective of potentially acquiring an e-commerce business. So remember that this is the kind of stuff and who it matters to, right? Somebody acquiring your business, if they come in and they see that there is a whole bunch of big question marks about tax liability in states, then that is one potentially good reason to walk away from an otherwise enticing deal. So just remember, when you have big events coming up that you're planning for that involve people outside of your business coming in and either buying it or contributing it to it in some important way, those are the kind of times where this stuff starts to matter more than when it's just you running as fast as you can to kind of get to that milestone.
Yeah, and if they're carrying liability exposure, obviously you can factor that into, whatever purchase price you have. So
Yep. Awesome. And I think we've touched upon this a little bit, just kind of tangentially as you've gone through, but let's talk a little bit because I think it comes up here in terms of the differences between physical and economic nexus and how they interplay, right? So if you do have an employee in a state, right, very obviously 99% of the time you have now triggered physical nexus and you likely need to go through the foreign registration process and likely then start filing yearly or bi-yearly with the state to say, hey, I still want to do business here. And maybe depending on the state, you may have to pay them just some franchise tax to say, like, yes, I would like to continue to do business. How does that actually interact with economic nexus? Are they completely overlapping and related? If you have one, do you automatically trigger the other? How do those work together?
yeah, so physical nexus is always the first trigger you should look at, right? Because that's the obvious. We have an employee, we have inventory, we have offices, we have 1099 employees that sell our product that we commission, right? So we pay commissions too. So all of that are common triggers. There are some of the not so common where you you go to a trade show, you sell product at the trade show. So there's other ones that are not as, black and white, and they vary by state. But I think the common ones you want to make sure are obviously just employees, offices, inventory. Those are three very common triggers, and you want to make sure where you have that exposure. When you think about economic, you can also think about it in terms of, the size of your business. So if you're just starting out, you're just beginning to sell, typically you're going to be really focused on, hey, I have an office in, California, so I have to collect in California. So that's where you're focused. And then you get to maybe 500,000 a year in sales nationwide. You may trigger one or two more states, and then you get to 1 million, and you may trigger another 3 or 4 states and so on. So we've actually done analysis based on census data, tied to, like, the average purchases per state by consumers. We've overlaid that with the state economic nexus laws. And the reality is that even when you get to 1 million, 2 million, 3 million, you're, in that phase, you now have multi-state compliance almost guaranteed, which is insane because, again, now they're bringing basically the complexity of multi-state to a company that does a couple million a year, right? So you're now having the same complexity that these bigger companies have, but you're only doing a couple million a year. And that's where I think we talked about the concept of just having some monitor as you start to grow. So once you cross that couple 100,000, you're at 500,000, really making sure then you have something in place to effectively track, your exposure, because, to go from that couple 100,000 to that, 5 million, right? Sometimes it happens a lot faster than you expect, especially I've seen some of these D2C brands. I mean, things can take off pretty quickly. So you want to make sure you're in front of that risk and you're tracking it. And once you start to get some sales, I think, that couple 100,000 range, that's when you really want to start to track it.
All right, awesome. Thank you. Next up, we've got a question around moving and incorporating a startup in Delaware in 2024. So I guess three-part question. When is a good time to incorporate tax-wise? I guess we'll start there and then we'll move on to the next ones.
When is a good time to incorporate in one of those states?
Well, I guess they're planning to incorporate in Delaware. So I would say from an overall tax perspective,
There's no sales tax in those states, which is
yeah,
nice, like Delaware or Wyoming definitely Delaware. There's no sales tax. So, I mean, ultimately if you're international and you want to get set up in the US, there are states that do require that you register your business, you incorporate in a state. So that's part of the registration requirements for certain states, along with EIN, bank account number, right, and so on. So a US bank account, et cetera, that the states require. But there are some states that require you to register your business, for example, in like Delaware. But there is no sales tax in Delaware, which is a nice thing.
Yeah, now timing wise, from a Delaware standpoint, Delaware is a state that does assess a yearly franchise tax, and that
Correct.
is assessed on a calendar year basis. So if you incorporate, say, in December of a year, then you will immediately owe the Delaware franchise tax, likely somewhere around 450 bucks if you're a startup in March of the next year. So timing wise, you can save yourself close to 500 bucks by waiting until the year boundary. And generally, if you are looking at a conversion, something like switching from an out-of-state C Corp to a Delaware C Corp in order to pursue fundraising, or converting an LLC to a C Corp, especially if there are things like employees associated with those entities, then often it can make sense to time your transition with whatever the fiscal year is of the company. Generally, that's going to line up with the calendar year. So January 1st is a good target, but for some companies, it doesn't. Side note, don't vary that unless you have a very, very good strategic reason to do it, because it makes things more complicated in a variety of ways. All right. So next part of this question, if they are selling a tech solution and a subscription US wide, how do you stay on top of this economic nexus and sales tax burden? Just serving up the perfect question now, Matt.
Yeah, I think the biggest thing is first, I want to understand the subscription I offer. How is the product defined? Right? Is it software as a service? Right? Is it digital content? Is it both? What am I, how is it delivered? So I want to understand in terms of what is the taxability of my product or service, because there are a lot of exemptions in the digital SaaS space and so on. So I want to make sure I understand, first off, where my product or service is taxable, what states. By the way, Washington, where I am, taxes everything. So you can always assume Washington is going to, for sales tax, is going to probably tax it. But I think the other component to that is then, how you track it. And I think what we find is early stage companies, they may be using everything from an Excel spreadsheet to take orders to QuickBooks. They may be using Stripe, right? Different platforms where they're selling on the digital space. And I think some of these platforms like Stripe have their own tracker built in, so it's part of your dashboard. Um, and so on. So I think you can look at, when you determine your order to cash scenario, wherever you're invoicing out of, do they have something that tracks economic nexus? And sometimes they do, right? And sometimes they don't. And if they don't have that, then think about, do you want to partner with a technology provider in the tax space? Because most technology providers will either have an integration to the platform potentially you're selling on, or they'll give you the ability to get the data into their service, and then they'll provide the tracking mechanism within their system. So a lot of the services today will offer that built in. So it just becomes another service that you can, you'll have to go to another, sign into your other account, just check your, where you sit from an economic nexus perspective. The other thing that is really nice to have as well is just automatic triggers. So if you're using a partner that basically tracks all of this and just sends you a text or email that says, hey, you've triggered economic nexus in this state, just click here to approve the registration. That becomes really nice too. It simplifies things, and it just makes it easy for you to manage it. So you can manage it from your cell phone, which is the ideal world. So one, look at the platform you're selling on. Do they offer something? And then two, also look at, do you want to go to a technology that offers it? And then what service do they provide around it? Do you have to track it, or do they have automatic notifications?
Awesome. And to dive into that a little bit more, we've got a question from somebody who is using Shopify. which obviously I think you showed in the presentation does have some tracking for, when you hit some of those economic nexus thresholds. What is the difference between working in there and working with a technology provider like Zamp? What does Zamp offer on top of Shopify or Stripe and the texture integration, or something like Lemon Squeezy?
Yeah, sure. So when you think about Shopify, right, they've got Shopify tax built in, which you can use to calculate according to all your orders. And it's gotten pretty good over the years, right? I mean, I think it's made some big strides in terms of accuracy. And they've also built in tracking within your Shopify account. So all the orders that they're consuming, they can apply the appropriate state rules and provide you a dashboard view of where you've triggered economic nexus. I think the benefit of a technology partner, like a Zamp, for example, is we will link into your Shopify account. We'll automatically pull all those orders in. We'll also consume orders they may not be going through Shopify. So it could be Amazon orders. It could be your wholesale orders that you're doing in QuickBooks, for example. So we'll also factor those in back to the earlier part of the presentation. So not just D2C, but wholesale and marketplace. And we'll give you a full view of your exposure based on all your channels. And then the other component is the physical nexus side. So again, having a partner that can educate you, based on your business model, whether you have nexus in a specific state tied to any physical activity that you have, hiring a new employee and so on and so forth. So I think that there's that value of working with a tax company. And then the other piece, of course, is the technology provider. Shopify doesn't do any remittance to the states today. Any tax technology partner you'll work with will provide the reporting, the filing, handle tax notices, provide the full service that, can basically allow you to automate it and, to put the responsibility on them to handle for you.
Awesome. So essentially sitting on top of all of your revenue streams and then also handling some of the back office, including actually filing, giving you notice when stuff is due, and then actually remitting the sales tax to each of the states.
Yep, that's correct.
Okay, cool. All right, we have a question that is a little bit off topic for sales tax, but on topic for mission control and what we're doing generally. So we'll try to get through it quickly. And Hael, if you're interested in diving into this more, mission control might be a great place for you. But is it better to have an LLC or C Corp to sell to US clients if the co-founders are all non-US residents and non-US taxpayers? The answer is, as always, it depends. Largely, it will be dependent on what you want for the business. If it is a business that you want to run for a long time and generate revenue, and you won't be hiring a lot of people, you won't be taking anybody's outside capital, and you won't be issuing equity to more than the founding team, then an LLC might be a perfectly great structure for you. However, if you are going to grow a large team around it, incentivize them with equity, if you have plans to fundraise from VCs, angels, or even contract with larger business entities to grow into a sizable business, then likely you will want to form a corporation. The big difference is that the corporation is going to file a tax return as its own entity, completely separate from sales tax. There will be an income tax return that it needs to file as its own, whereas an LLC will be a pass-through entity. You may still have some tax issues that you need to navigate in your locality outside of the United States by being a US business owner. But that's kind of the high-level basics in terms of making that choice for your entity type for the business. And Matt, anything else you want to add on top of that?
No, I think we covered a lot of good topics here. I think again, the reality is state governments have made it difficult, and not easy for startups and small businesses. There is, of course, technology that can help support you. I think the biggest thing you can do though is taking the action of, understanding, as best you can, what your compliance requirements are as you start out or you're in early stage, getting in front of that risk. And then as you start to grow and generate revenue, look to partner with somebody who can provide you the foundation for, managing the liability, handling all of the components of it, tracking and so on and so forth. Because I think that's ultimately what's going to, in the long run, you fast forward 5 years from now, you'll be happy that you addressed it up front. And I think as Peter talked about, whatever you end up doing with your company, it gives you probably some better options down the road in terms of being fully compliant versus, the head in the sand approach, right? And then if you have made some mistakes, made a few mistakes, it's okay, right? I mean, everything is correctable. And again, I just think but you want to address those mistakes as soon as possible because they do accrue interest and penalties over time. So again, look to partner with somebody and get those things addressed.
Awesome. Thanks, Matt.
Yeah.
And just to reinforce, if you are looking for that type of support and kind of a 360-degree perspective for your startup, including chatting with people like Matt about sales tax, chatting about SOC 2 compliance and where that might sit on your strategic roadmap, startup insurance, how to split equity with your co-founders, and all of the interesting taxation issues that underlie that, how to actually form your company and choose between an LLC and a C Corp or switch between the two, and sharpen your pitch and make sure your financial model is telling a story that you can believe in and your investors believe in. That is exactly what Mission Control is for. We have deep dive sessions in virtual person. You get to talk to people like myself and Ryan and Matt and David to get all of this stuff in a row and understand where you need to put your attention when something arises to the point where it's worth your time, when it's external to actually building your business. So if that sounds like it is interesting, come check us out. Matt, thank you so much for being here today. Look forward to having you in again sometime soon. We will get the recording posted hopefully tomorrow, if not the day after, and we'll get it sent out to everybody who RSVP'd.
Appreciate it, Peter.
Thanks all.
Thanks, everyone.